who he doesn't have a history in the financial services, but he does a really great job of breaking down this story. If you're a fan of RedState, you know him as Shipwreckedcrew, and you can follow him on Twitter at that same handle. Thank you so much for joining us, Shipwreckcrew.
Good morning. How you doing?
I'm good. So
I guess it's now afternoon for you.
Yes. I loved your story because it really helped. You actually said shorting stocks for dummies. And that's what I needed when I woke up this morning to kind of wrap my head around this whole thing. I think the most helpful part of it is when you explain, which may seem basic to some people who know this better, but for anyone listening with my level of knowledge on it, can you first explain to people what shorting a stock means?
Shorting a stock is essentially just selling a borrowed stock. And what you're doing by selling a borrowed stock is you're betting on the value of that stock going down. Because when it goes down, then you buy it in the market and return it back to the person you borrowed it from. And you keep the difference between what you originally sold it at and what you had to buy it back at. So if you shorted it $100 a share, it goes down to $75 a share. You buy it at $75 to give it back. You keep the $25.
Got it. Okay, so now what I'd love for you to do is explain from the start what happened with these Reddit traders and why they chose GameStop.
Well, GameStop is a brick and mortar company, in the video game sales business. It does a lot of other things, but that's sort of the core of its business model. It has historically sold the actual game disc, in the little boxes, the DVDs. And as PlayStation and Xbox have matured, the players can now simply access the games directly through the internet without having to buy the disc. So it's kind of made these disc sellers, somewhat obsolete and superfluous in the market because now they're not necessary. So it's been on, with COVID and everything else and all of the, problems with bricks and mortar retail sellers from, Amazon and Walmart online and Target online. It's been under pressure for a while in terms of its stock value and the value of the business declining, and it's, sort of on a death watch. Probably will eventually go out of business unless it finds some other business model to sustain itself. So hedge funds, and hedge funds get a bad rep, and I'm not going to try to defend them here, but hedge funds have a purpose in the market for certain investors, and some hedge funds' orientation is towards shorting what they believe to be overvalued stocks or stocks that are likely to go down significantly for market reasons in the future, like GameStop. So some hedge funds, and there's a lot of them, but a few in particular kind of piled on to GameStop and took significant short positions, betting that the GameStop value share price would decline in the near or intermediate future and eventually maybe go down to zero if GameStop was forced to file bankruptcy at some point, like Borders or like Toys R Us. And then they would cash out, because they sold shares by shorting it at whatever number. I mean, it was $18 back on January 1st. And then, had been hoping for a continued decline in the value, at which point, they'd buy it back at $1 or whatever and kept the difference. Well, as I said in my article, I wasn't able in the time I had to figure out exactly where the genesis of this move against the hedge fund short position started. But it seemed to me from some of the things I read that it might have been just gamers on a Reddit community bulletin board that is dedicated to what's called Wall Street Bets. And it's basically just, day traders and retail investors and stuff like that. And within that community is a sub-community of gamers who apparently took offense at the efforts of the hedge funds to drive down the value of the GameStop share price in order to, maximize the value of their short positions. The hedge funds were aggressive. There's no question about it. I mean, they had shorted massive amounts of shares, and shorting itself can become somewhat of a self-fulfilling prophecy because when you short a stock, you are actively selling shares into the marketplace, and that fact of itself drives down the value of the stock.
So that's where I get now. I just want to stop you there because I had a conversation with someone this morning, and they kind of said the same thing, where they said a lot of times people have a bad view of these hedge funds because they feel like they go after these companies that are already struggling, and they kind of drive it down by shorting it. But why is that? So is it kind of like a PR thing where people start hearing that you're getting shorted and they feel as though you're less valuable?
Yeah, this is a long established Wall Street practice when short. So there are investors there are hedge funds that short, and hedge funds are money managers for very wealthy people, and that's their whole strategy. That's why people have put money with them as a hedge against the market going higher, and that's a whole different conversation. But that's the purpose of hedge funds, and they have a value in the marketplace. But there are also just traders institutional traders or big money traders who just short stocks. That's their strategy. And what they are looking for is a stock that on its valuation and on its financials is overvalued by the market. A stock that is higher than it should be, at least in the opinion of the traders. So they start shorting it. They sell it. But again, in the marketplace, when there's more buyers, the stock goes up. When there's more sellers, the stock goes down. So these short specialists get in, and they start aggressively selling shares via shorting, putting pressure on the price to go down, and then they go on CNBC or other media outlets and start screaming about how that company is overvalued and it's going out of business. And bricks and mortar is a clear candidate, or bricks and mortar, GameStop, as a brick and mortar company historically, is a clear candidate to suffer in the current market environment, COVID and online shopping practices. It's Blockbuster. It's Blockbuster a year before Blockbuster went out of business.
Now, all of this was interesting enough in watching it, and it was on the cover of the New York Post. But then something happened that was really outrageous, which was Robinhood, which is the popular trading app, decided that they were going to freeze out these Reddit traders. Can you explain that part of it a little bit?
Yeah, I just kind of saw this morning, and it's not a little bit of two minds about what Robinhood is doing, because the problem is that the market is not what they call orderly. There's no, the market orders itself by having available buyers, available traders, or available buyers, available sellers on both sides, and then the market makers put people together. They match sell offers with buy offers, and that's how you come up with a share price, and it goes up and down depending on the interaction all day. Well, the problem with GameStop is all of the action right now is either on one side or the other. That's why the price is, it was $490 earlier today, and then it was $117. That tells you there's not an orderly market. There's no lineup of buyers and lineup of sellers with similar numbers willing to trade back and forth. They're either all on one side wanting to buy or all on the other side wanting to sell. So you have these wild swings in value, and an online app like Robinhood is, frankly, I don't think they're prepared to manage that kind of market. Normally you have large Wall Street firms that serve the function of what they call a market maker. They stand in the middle. Somebody is offering for $25 to buy, and somebody's offering to sell for $26. The market maker might make the deal at $25.50 and charge a commission. So they make their money on the commission. But they make the deal happen, even though there's a little bit of a spread between the buying price and the asking price. There's no market makers in this. Nobody's getting between buyers and sellers with the volatility. So Robinhood, which is just, I've never used it. I don't know exactly how it operates, but I'm going to guess it's just an online electronic trading house. They've got people apparently who want to sell, but they don't have anybody who wants to buy.
Right.
So, so I'm a little bit sympathetic. I just don't know enough about what they've done. I'm reluctant to simply say, oh, Robinhood is trying to cover for the hedge funds and not let the retail investors sell their shares at the profit of where they are. And the suspicion is that by not allowing the small Reddit people to trade out of their positions, they're at the same time allowing, the big institutional houses, Morgan Stanley or whatever, they're trading for the hedge funds. It's only the Reddit guys using the online apps that are closed out, whereas the big Wall Street firms are continuing to trade the positions of the hedge funds. And one of the problems is tomorrow is the closing day for options, and that's a whole different discussion that complicates this matter, because option positions have to be closed on tomorrow's the last Friday of the month, and so there's billions of dollars in options contracts out there that have to be worked out, and those generally are mostly big traders.
Now, I have one more question for you. A lot of these now a lot of people are talking about regulations and the government needs to regulate this more. But a lot of these rules were set up and they helped the hedge funds at one point, right? So when people say, well, you're just mad that people are beating you at your own game, do you think that's true, or do you think that we do need more regulation?
Wow, I'm the funny thing about the stock markets is those are private enterprises. The New York Stock Exchange and the Chicago Mercantile Exchange and the NASDAQ, those are private businesses, and companies go there, take their companies public. They're regulated by, Securities and Exchange Commission and securities laws, how they function, to make them fair. And it's just, the whole, online trading started quite a while ago. But, as I said in my story, this looks like a completely different beast, because you've got online activism driving trading in ways that the regulations don't really address or anticipate. So the option is to say, hey, it's, Lord of the Flies, survival of the fittest. It's a jungle out there. You buys your ticket and you take your chances. Or you say, no, there's too much money involved. It's not just the hedge funds guys are on the hook. The people on the other side of those trades, the Reddit investors, they're on the hook too. They've got money in the market. Now, the problem is that the move by Robinhood might be, blocking them from being able to eliminate their risk and get out of their positions, and that's a problem. And I just saw 20 minutes ago, there's already been a class action lawsuit filed in New York against Robinhood today, that quickly. A law firm jumped on it and filed a class action lawsuit against Robinhood for having locked people out of their accounts. Or actually, I don't think they locked them out of the accounts. They basically just said you can only trade one way. So
wow. Well,
there's going to be lots of hearings, and there might be new regulations, but what form those might take is anybody's guess.
Shipwreckedcrew is on RedState. You can read his article. It's awesome. If you find yourself like me and you're trying to figure this out, but you want to take on it that kind of breaks it down in a little bit of an easier way. This is a great piece. It's called What Happened with GameStop, Reddit, and Some Wall Street Hedge Funds, and What Might It Mean? He does go into that activism and, what would have happened if these Reddit traders decided to do this with, let's say, Twitter or, another business like that. It's really interesting. I thank you so much, Shipwrecked Crew, because you explained that perfectly, and I really appreciate it. Before we go to break, I have to let you guys know, sticking to your New Year's resolution is a matter of making one right decision at a time. It can be tough. You want to change your life right on January 1st, and then you slowly go back to your old ways. Well, you don't have to if you try SuperBeets Heart Chews. If you're looking to institute some healthy habits that are easy to do every day, this is the first step. I love it because I have poor circulation in my legs, and it really helps with that. Just 2 SuperBeet Heart Chews per day give you the cardiovascular support and promote the heart-healthy energy you need to chase your goals. SuperBeets Heart Chews combine non-GMO beets and clinically researched grapeseed extract, shown to be 2 times as effective at supporting normal blood pressure than a healthy lifestyle alone. When it comes to implementing healthy habits this year, adding SuperBeets Heart Chews to your daily routine is an easy decision to make. Plus, they taste very delicious. People ask me this all the time off the air. They really do taste great. It's like a Starburst, except it's healthy for you, which makes it even tastier. And now you can get a free 30-day supply of SuperBeets Heart Chews, plus a free 30-day supply of their new delicious flavor, Super Grapes, with your first purchase by going to getsuperbeets.com/grace. That's 2 free gifts valued at over $50, only available at getsuperbeets.com/grace. That's getsuperbeets.com/grace. We'll be talking more about this as the day goes on, but we are going to get into the politics. I feel I can take a deep breath now. We covered the GameStop drama, and now I can move on to where I really feel I'm an expert, and that's calling out John Kerry on his hypocrisy. We'll be right back, guys. Don't go anywhere. This is The Grace Curley Show.
You're listening to The Grace Curley Show.